Welcome to this Killick Explains video, and this week I want to take on a topic that's been in and out of the press for years, but it's back in again now, and that is, are passive funds, whatever they are, storing up trouble for investors? So let's have a circle back on a debate that's been raging for a few years, and as I say, has resurfaced just recently. So it's certainly been a rapid rise. Passive funds, come back to what those are in just a moment, are thought to account, depending on the data you look at, for up to 50% of global equity fund assets, which is quite an incredible figure. And that's around 13 trillion US dollars. And basically the critics are saying that may sound good on one level, but actually there are three problems. It distorts prices, it raises volatility, and it creates lots of corporate governance headaches. So what I want to tackle in this video is, how true are those three complaints? So first of all, just a reminder, what is passive investing? Well, passive investing essentially is where somebody sets up a program, an algorithm, to just mirror the performance of something like a stock index, the S&P 500, doesn't try and beat it, just follows it, tracks it up and down, if you like, via a share, let's say, listed on an exchange. So as the index moves, so does the share. And these can be simple or complex. So something that tracks the S&P 500 or the FTSE 100 is fairly straightforward. More complex ones will try and copy strategies that have worked in the stock market in the past. But the point is, they're passive. There are no humans involved in running these things. They are just machine-driven funds set up, and they just execute their strategy silently without any human input. Okay? Now, the question then becomes, what's the problem? And one of the criticisms I mentioned just now is that these things are set up to follow price, but not value. Now, what do I mean by that? Well, that effectively means is these programs are hoovering up stocks in such a way that they buy them high and sell them low, which is the precise opposite of what you want to achieve as an investor. They tend to buy expensive stocks as the price rises because they have to. If they're trying to copy an index, they've got to make sure they're mirroring the constituents of that index. They'll tend to buy the biggest, most expensive, highest market capitalization stocks and sell low. And you can get a vicious circle building up. And we've seen this around the Magnificent Seven tech stocks, if you like. So goes the argument, whereby a share price for an important stock, a Tesla or an Nvidia, rises. All right, these passive funds pile in as they have to. They've got to own these big, important stocks, if you like. That pushes up the stock, pushes up the index as all the other passive funds pile in automatically behind it. Suddenly, the fund hasn't got a sufficient weighting in that big stock because the index moved up, so it buys more. And it's kind of helter-skelter ladder effect, where these programs are forcing up the price of a fairly small number of stocks, which then constitute a huge part of the market and a huge part of the index. And we saw just fairly recently what happens when investors suddenly lose confidence, and an Nvidia, suddenly loses 450 billion US dollars in value in a day. But in case you're thinking, so this is a problem then, basically these things are distorting prices because they're just chasing a smaller and smaller pool of stocks higher and higher. They're forced mechanically to keep buying, even when market indicators suggest the market's getting too hot and overpriced. So is there a problem? Well, maybe not yet. I'd say the jury is out, okay? ETF, that's exchange traded funds, that's a typical passive instrument. Turnover, according to Bloomberg, is relatively low still compared to some active funds. And you'd think it would be higher if these things were just churning stocks on a regular basis. And the evidence they actually move prices significantly is kind of patchy. And when you talk about Nvidia, these are huge, huge liquid stocks. It's pretty unlikely that even a group of passive funds is able to move the price of even one of them, let alone the whole group, okay? Even given the numbers I gave you earlier on about volumes of these things. And there's actually a counter argument that says indexing, all right, and most passive instruments require indices, that's what they follow, these indices, may actually improve price discovery because it allows more stock lending, and it allows the people that bet against share prices, called short sellers, to operate more actively. So some people would say, actually, Far from weakening price discovery, far from just hurling momentum at a small collection of stocks. Okay, the very existence of passive funds facilitates people whose very existence is predicated on spotting overpriced stocks, shorting them, and bringing the price back down. So you have it. Jury's probably out on number one. Number two was, do these things, is the amount of money, the wall of money heading into passive instruments, is that causing extra volatility? Now, the logic is simple, if you like. What we're saying is if all these passive, 13 trillion US dollars worth of passive funds are piling into a fairly small number of stocks, even if they're good value, it's going to move the price up and down as they go in and as they go out. As the herd changes direction, you're getting more and more stock market volatility. You're going to get accentuated moves. Michael Berry, famous contrarian investor, put it this way. He said, the theatre's getting more and more crowded, but the exit's still the same. In other words, as these funds all hit certain price trigger points, they all try and pile through the same door, and that creates extra volatility, if you want to see it that way. So against that, actually, we could look at what happened recently to Nvidia, that big share price drop, and say, actually, the reality is most investors used to panic, but a lot of active investors don't. So let's say these passive funds are dumping stocks en masse. Quite a few active investors, quite a few retail investors don't panic and accentuate the move. They stand back and look to buy. They can see an opportunity to buy something that was more expensive yesterday, cheaper today. And you'd also expect, if this was a big problem, you'd expect that there would be an active fund advantage, but actually there doesn't seem to be too much evidence of that. And so the volatility argument, again, is kind of not really made or set in stone, if you like. I say the jury is still out. We'll probably get to a point where, like argument number one, there is a problem, but some people would say we haven't quite got there yet. Now, on the third criticism of all this passive activity, corporate governance, there is, I would say, undeniably more of an issue. What is the issue? What it is, if you've got these huge fund houses like BlackRock, for example, pumping out these passive products that hoover up loads of the shares in the market, they also hoover up all the voting rights that go with those shares. And that means that these single houses that create these instruments can control enormous blocks of voting shares in the market, and they can push their own agenda through companies because they've got such power over voting and so on. And there is some truth in that. What I would say to counter that is people know it's a problem. I don't think anyone denies it's a potential problem. There's much more awareness of it as a result, and that means there is more and more pressure being brought to bear on the BlackRocks of this world, for example, to introduce, for example, proxy voting, to take account of the fact they do represent the interests of a large pool of shareholders through these passive exchange-traded funds and so on. So that's a kind of watch this space. I would say on problem number one, the jury's out, price discovery. Number two, this volatility argument, probably getting there, maybe not there yet. On corporate governance, there is a problem, but people have recognized it as such and are gradually bringing pressure to bear to do something about it. Now, the question then is, what do investors make of all this? Well, I would say, don't panic. I mean, by all means, read the press around this stuff, and there is quite a bit of press around it. The FT picked this up recently again. Basically, when it comes to fund investing, quite simple. In a big liquid market, American stocks, for argument's sake, don't be afraid of passive funds. They do a perfectly good job. They're efficient. They can give you the performance of the S&P 500 probably more efficiently than any active fund manager can, realistically speaking. But when you're in a part of the market which is less liquid, more awkward to get to, Indian shares, for argument's sake, or where there is basically value in being a specialist, then active funds, I think, will always have a place. And although there are people like David Einhorn saying, well, with all this price momentum created by passive funds, you actually can't be an active investor anymore, because even when a stock is cheap, no one's buying it like they would have done in the old days. I'm not sure that's 100% true. I think active funds can do their job perfectly well in parts of the market that are more difficult to access. And then, of course, let's also remember as an investor, you don't have to buy a fund. All right. If you want to get into a particular part of the market, quite a few people like funds, especially if they're only investing a relatively small amount. But you can go 100% direct equities as well. All right. And some investors with more money to commit to the market will do that. All right, they'll dodge funds altogether, pick up their own portfolio of 30 shares for argument's sake, and you can mix and match the two to an extent. So nothing I've said threatens those thoughts on how you play the market. So at the end of all this, I would recommend that you still stick to long-term investing goals. Don't change your strategy in response to a few media articles. That's never a good idea. Pick the most efficient way to achieve your investing goals, and I've hinted at where passives versus actives can fit in there, and on some of the bigger criticisms of the passive industry. Watch this space for now. Okay, if you want to know more about any of the jargon I just went through, then it's killick.com/resources for more Killick Explains videos. Get a copy of my How to Invest in Equities guide there as well if you like, in online form, and of course our quarterly magazine, Confidant.